Let's start streaming. Okay. All right. Good morning. Today is the June 27th. I just want to remind anyone who is taking the course online, we got, guys, 1 or maximum 2 more days to submit any late assignments. Other than after the 29th, it will be impossible to change anything. So if you are listening, or you're going to listen today or later, just remember today and tomorrow are the last days to 28 and 29 are the last days. I'd rather have it on the 28th so I can grade it and update your evaluation. Thank you very much. All right, now we go back to chapter 13. Like what we said yesterday, today we are going to do the accounting for stocks. And so if we go to chapter 13 in the textbook, 2 pages, let me find the pages. All right, starting page. Did we say 500 yesterday?
Yes, I believe it was, because you said we were going to do some examples.
Or 501 maybe?
Yeah, I believe it was 501 too.
Okay, let's go ahead and look on page 501, and we look at issuing of stocks for par value. Now, what's the difference between par value and no par?
A par value, you gotta have a specific amount that you have to have.
It's stated in the article of incorporation that it is a par value. Yeah, and the no par is?
You don't have a minimum of what you can.
It's no par, but it still have a stated value.
Oh, yeah.
But it's not called a par value, all right?
Yes.
And the difference between the two is when it comes to the legal capital, the minimum legal capital. That's the major difference between the two. Yeah. If there's any liquidations, shareholders, if it's they are entitled to at least the par value or the minimum legal capital. Okay, so let's take a look at this issuing stocks first for above the par value. Issuing stocks for the par. Let me first give you a. Let me go back to Word, no, to Excel, yeah, for a second, and let me give you the generic entry for issuing stocks. All right, issue. It's not issuing. Issuing stocks. All right. For issuing stocks, let me bold and the generic. Now, when we issue stocks, we are getting either cash or some kind of assets. Yeah. All right. So we're going to debit. You automatically you debit either cash or whatever assets you're getting. So I'm going to say cash. Okay, you're going to debit cash. And what are we going to credit? We credit common stocks. All right, we create automatically. Okay, you created common stocks. You also, if you, naturally we're going to issue the shares for above the par value. Therefore, we're going to credit. What do we call that account that we get? What did we call it yesterday?
Treasury stock.
Nope. We call it additional capital.
Additional capital.
Yes, sir. Additional capital in excess of par value. All right. So I'm just going to call it additional paid in capital. Additional paid in capital. Let me make it a little bit nicer. And we go down to here. All right. So you're going to debit cash and you're going to credit. Automatically, we credit common stock because it is an increase in common stock. Common stock is an equity, and when it increases, it is credited. So that means it's an increase in, and also capital, also that's an increase in capital, it has to be credited. All right. Now, if you are, we're going to see in a minute, so just remember that, this journal entry, okay? All right, so we go back to page 501. It says Rexu Corporation is authorized to issue 10,000 shares of $10 common stock. All right, so their authorization is going to be $10,000 and the par value is $10. The par value is $10, all right? On January 1st, 2014, it issues 5,000 shares of $12. So, on this journal entry here, you see cash is going to be for how much? In our example.
Do you want me to write the par value or how much they really made off of the shares that they sold already? You know what I'm saying? Like, do you want me to go ahead and calculate the...
Yes.
Okay.
Calculate the cash they're getting.
Alright. 5,000 shares at $12 each.
Uh-huh. Exactly.
60,000.
Huh?
$60,000.
So we're going to debit cash $60,000. And we're going to credit automatically. What do you say we credit?
The common stock.
All right, so common stock at par value. Common stock at par. For how much was the par?
$10.
$10. So how much is that going to be? They issued 5,000 at $10.
Per par value.
So that's going to be
$50,000.
$50,000. And the difference is, what do we call it?
The additional paid in capital.
Yes, sir.
And you credit that for $10,000.
Additional. Let me call it additional PIC.
Oh, okay.
PIC, paid in capital. Additional PIC for $10,000. All right. So this is the if the shares are issued for above the par value, and they should be issued for above the par value.
They'll make no money.
Yes, not making money. They are not raising capital.
Oh, yeah.
All right. Always remember, they are raising capital. They are not making money on it. All right. But how can you make money, by the way, of stocks? How can you make money if you are investing? You as a shareholder, all right? If you invest, if you buy shares Now be careful. Here we talk about the point of view of the corporation who's raising the fund. But if we talk about the point of view of the investor, like yourself, for example, if you buy shares, let's say you bought some of these shares at $12, you as a shareholder. All right, you bought it for $12, correct?
Yes.
Maybe down the road, the price became $15, $16. So you sell your share. The money you make is an income to you. All right? But for the corporation, the initial issue is a capital, additional capital, yeah.
So
Now the corporation itself can also be an investor. They can invest in other places too and make money, yeah. So you gotta be careful from the point of view of the investor or the point of view of the issuer, the one who is raising the fund, yeah.
So the only way to make money if the price of the stock, price of the share rises basically, and they just choose to sell it. All right.
Say it again.
The only way the person that buys the stock, the only way they make money is if the
Yes.
share
Or
appreciates.
another way is if you hold the shares and you receive the dividends as an investor, yeah. Two ways. Either you're receiving dividends or you sell your share when the price is up as an investor. All right. So if I were to do a stockholders' equity at this moment, how would it look like? You're going back to stockholders' equity. I want you to remember it from your mind.
okay.
Then what are the components of stockholders' equity?
You got your
Contributed capital,
Contribution,
retained earnings.
additional paid-in capital for that preferred stock. Right.
All right. We don't have preferred at this time.
oh yeah. But
So our contributed capital as of this moment is only including the par value, the 50,000, and then the additional paid-in capital,
10,000.
common stock,
It's 10,000.
10,000. So total stockholders' equity at this time,
60,000.
the retained earnings is zero
Oh, 10,000.
as of this moment. Yeah.
Mm-hmm.
All right. You remember how the skeleton looked like of stockholders' equity? You sure? The title,
Then you got the stock.
contributed capital, the components, retained earnings. If we have a treasury stock, we say subtotal, then we minus treasury stock. No treasury stock, then will be
Right at.
retained earnings and contributed capital.
Okay.
All right. Now, if we issue no par, shares, on the next page, okay, if we issue no par, okay, no par stock. Let me bold it and make it a little bit larger. No par stock. We still have a stated value. It doesn't mean it has no value, all right? Doesn't mean that. Let's say on January 1st, 2014, RIXU issues 5,000 shares of no par common stock at $15 a share. At $15 a share. So we're going to debit what?
The cash.
Cash automatically. Cash. For how much? Oh. Gonna debit cash for how much? It's a 5,000 at $15.
5,000.
At $15, that would be 75.
Yes, sir.
Yeah, $75,000. And we're going to credit.
The common stock.
Common stock for $75,000. All right. Now, if we issue no par stock with a stated value, if it has no, with a, let's say, if it has a stated value, assume the same facts as were provided previously, except that the ratio put a $10 stated value. It has a stated value of $10, but it was sold for, issued for 15. So we're going to debit cash we're going to debit cash for still $75,000. And we're going to credit. What do we credit? Yeah, common stock. Common stock for how much?
75.
Nope.
$50,000.
$50,000. Yeah. And we also going to credit.
The additional paid in capital.
Yes, sir.
That's going to be 25,000.
Mm-hmm. We're going to credit additional PIC. PIC means
Paid in capital.
paid in capital, okay, for $25,000. All right, for 25. Good morning. All right. Okay. Good morning, Dr. Johnson.
How are you?
Doing good.
So you have internet service?
Yeah. Mm-hmm.
Okay. Because the other room doesn't have it, so how
Yeah, I logged in and.
okay.
Mm-hmm.
Wow. Okay.
Yeah,
Thanks.
see, we are doing the recording.
Okay.
Yeah, we're
All right.
recording.
Thank you, Dr. Ali.
You are most welcome. So, this is how we record the issuance of the no par. It has a stated value or none, or it has just says no par. Yeah.
So if it's no par, like no par, oh okay, so they
But
said
still
it-
have a stated value. Yeah.
okay, but no par with no stated value is gonna be exactly
As a
what
sale
it's-
price. Yeah.
Sale price, okay, but with a stated value, it's gonna put
Just like in a normal.
just like with the par stuff.
Yes.
Okay.
Mhm.
Yes.
Brother Darian, let me just give you an update since you just came in. Now, the only way, what is standing in your way for the B is that you have chapter 2, I haven't got that, chapter 5. You gave me 10 yesterday, you gave me 2 yesterday. I haven't put 10 yet, because you haven't submitted it yet.
Oh,
Yeah.
I forgot to click on mine.
Yeah, so I need 2, and I need from you 7, 8, alright?
Alright.
2, 5, 7, and 8,
Alright.
alright?
And I think I submitted it yesterday.
Yeah, you made on it 75. Yeah.
Alright.
So the only thing that stands between you and the B now is giving me those.
Okay, I got you.
Your cases are all okay. I got the cases.
Cool, cool.
All right. So if you give me those between today and tomorrow, you may end up with a B.
Alright,
And that's going to way improve your
About G.
GPA. Yes, sir. All right. See, I still have 10 from you.
Okay.
Yeah.
So I just gotta click on it.
All right. We only have 3 so far enrolled in 2. Guys, just remember, if they say no, we are doing this on our own.
Yes,
Now,
sir.
just be, the records show that we are doing this on our own.
Yes,
And
sir.
this still can be considered accounting 1 too.
Okay.
Yeah. So if we don't get the
so
5,
do you know who are the people who have enrolled yet? So I know who to.
see, yeah,
When is the last day to enroll?
Wednesday, yeah.
Okay,
I mean, no, sorry, you need to do it.
Well, no,
Saturday.
I'm already enrolled. I'm talking about
Yeah.
so I can get somebody else to enroll.
Bercy, I don't think he's gonna make it because he didn't give me anything so far. Garcia withdrew.
I just seen Garcia yesterday at my job, so I
Yeah,
need to he just got me, but yeah,
If he doesn't give me the stuff, he's not gonna see it's empty. I shouldn't show it to you because this is private. Goodrich Forster,
oh yeah,
I think he enrolled.
he is.
I think, I believe so. Graham, he probably didn't go yesterday.
Okay.
Yeah, Graham didn't go yesterday for some reason.
So me, him, and Goodrich only was
Yeah,
going.
Jimenez, he said he will do.
I mean, if all we need is 5, then we just need Larry and Ledbetter to enroll.
Yeah,
talked to Jerry.
Ledbetter, I haven't seen him. Ledbetter, if he doesn't give me the assignments.
I can call one
Yeah.
more person. So you have to have a camera.
Larry just texted me right now. He's trying to enroll right as we speak.
Oh, then,
Yeah,
say
as
Graham.
we
Okay,
speak.
good.
Yeah, so he just enrolled. So that's 4. Then I could get
So-
Ledbetter. I got his.
And Mr. Walsh,
I seen Jared a couple days ago, but I
do you know if he took accounting too?
I
probably
think.
have him, but I'm about to text
Call
him.
him, yeah. For me.
Okay.
Did a Tyler Cornelius take accounting 1?
Who?
Tyler Cornelius, I can call him. Cause he was in one of our classes.
I don't know if he did accounting one, I'm not sure, I don't remember.
Let me call him real quick.
Cause I'm gonna call, cause if I can call him, get him in the accounting too, that'll be good.
Yeah,
And when's the last day to rest?
This
I
week.
think maybe this week, yeah.
By Friday. Alright, you can call him right now.
Yeah, not for it's, I'm gonna send him a message.
Okay, while you're doing that, let me go get me some water.
Yes, sir. Hello. Yeah, we was in class just now talking about it, because he's saying we need more people to get enrolled. And I said, oh, you need to just text me so you trying to enroll right now. Alright, so how they trying to hold you? Were you trying to apply online? Okay. Oh, that shit, tell them, shit, they like, just tell them, you need to take these down, cause they gonna make you take 6 off the top, you know what I'm saying?
Okay.
Yeah, they should, you know they should try to apply for this shit, it's come to the, oh, okay, good. Alright. Oh, okay. Alright. Yeah, Larry's about to walk in. They say they're trying to mess him over or they're not trying to let him apply or something like that or enroll.
Say it again.
They said they're not trying to, he said they're not trying to let him enroll or something like that into the course, but he's about to walk in and explain what's
Okay.
going on.
Why wouldn't they let him?
I don't know, because he said something about
Financial
capstone.
aid?
Not even financial aid, it was like capstone with it and like,
With education.
yeah, they had no teacher.
Okay, alright, let's move along with, remember earlier we said we can issue shares of stocks for cash, and now we're going to look at issuing it for other than cash, for assets. So if you exchange a piece of land for shares of stocks, or if you pay the lawyer's fees with shares of stocks instead, yeah.
Okay.
So let's take a look at this example. When Rexu was formed on January 1st, 2014, its attorney agreed to accept 200 shares of its $10 par value common stock for services rendered. At that time, the market value of the stock could not be determined. However, for similar services, the attorney would have charged Rexio $3,000. So they did not know what was the market value of the share at that time. Good morning. How are you?
I'm alright.
Why wouldn't they let you enroll?
See what happened? I'm in Capstone. Well, I'm supposed to be in Capstone right now. And we have a teacher the whole time. And Monday, the teacher that's supposed to teach Capstone called me. And she was like, she gonna start uploading work Monday. So I've been to the register office, the business office, and financial aid trying to figure out what's going on, like how they gonna do it. They gonna recharge me or, and you know, you gotta take 2 classes. It's credit hours the
Receive funding.
Yeah, that's what I'm saying. So I don't. But they called me this morning when I was on my way, and they told me to just still register for account too. So
Okay, you wanna go?
yeah.
You gonna do it after
Yes, sir.
this class?
Yeah, I'm gonna do that.
Okay, yeah. Let me just give you an update, Mr. Grimm, where you stand. Okay. Did you give me exam 2?
Yes, sir.
You sure?
Yes, sir. I'm positive.
Oh yes, you probably did. Yeah. You know what happened? Let me tell you what happened. Yeah, I didn't put it in the system for you. You need to go in the system and just submit it.
Submit it.
Yeah, in the system. Go in so I can grade it
sir.
for you, and that would be you probably end up with a B most likely, because you. See, you're good. You got me chapter 1, 2, 3, 4, 5, 6, 7, 8, 9, and I need chapter 10 and the cases.
This 4, 5.
I got those. I just the cases.
Yes, sir.
Okay, let me get the cases. Very good. And that
I
probably
gotta
I didn't
do-
want.
I gotta do the
And
rest
this
of
too. You probably end up with A or B. Most likely, yeah.
Yes, sir.
So give me yesterday you were on the roll.
Yeah,
You
I
didn't
do
give
the
me
rest
10.
of them today.
Okay.
Yes, sir.
After you go for register first, then we do the give me chapter 10.
Yes, sir.
Yeah. Okay. Very good. Very good.
I ain't got a teacher for the class, but
Yeah, that's what I'm saying. Then Dr. Jones not even here. They say he's not gonna be here for the whole week.
wow, see, hey,
Where is he?
some of the staff they take vacations at the most inopportune moments, like the worst times. Like this is a vital week where everybody needs to get that stuff done, registered for the transition for someone or something.
Okay.
But you want to leave, and you're the main one that could put classes on, take classes off, handle stuff.
Okay. Brother Larry, we're going over.
Oh yeah, I was listening.
Yeah. Are you listening?
Mm-hmm.
Ah, okay. So, at the time, they didn't know what is the value, the market value of the shares. So we can know if how much it is, how much they are giving, how much the market value. So we know the paid-in capital, correct? Since they didn't know what the market value is, but we know the lawyer's fees are $3,000.
But
So the market value of the share is going to be the $3,000.
okay, but I mean, they give a bunch of shares though.
So
200
no, the
shares.
lawyer is only getting how many shares?
200.
Yeah, 200 shares. Not. Yes, it is. Yeah, but the market value of the share is $3,000 in this case. All right. So here is the rule. Here is the rule. If we don't know the market value of the shares or the issue price, not the par value, we know what the par value is, but we don't know what the issue price, then the asset is going to be, because we know the value of the asset, then that is going to be the value, the issue price of the shares.
Oh, okay.
And if we know, the opposite is true also. If we know the share, the issue price of the share, but we don't know the value of the fees for the lawyer, then we use the market price, or I mean the issue price, as the lawyer's fees. All right, just remember that. So we go back to this example. So what do we debit? What do we credit?
We debit the cash.
Now remember, we're not getting cash here.
There is no cash, so you're gonna.
It is a lawyer. We have a lawyer fees.
Okay.
So we debit either organization costs or lawyer fees or legal expenses, like the book is calling it legal expenses. So we're going to debit legal expenses
3,000.
for $3,000, and we're going to credit automatically.
Oh, common stock.
Yes, sir. Common stock for how much?
3,000.
How many shares?
200 shares.
200 shares at the par value,
Until that's
which
20,000.
is?
That's 20,000.
Wait a minute. 200 shares,
Times $10. That's 2,000.
2,000. Yes, sir.
Put it as a zero. Okay.
2,000. And the difference is?
The additional paid in capital.
Yes, sir.
Additional PIC.
Credit.
1,000.
Additional PIC for $1,000.
That's why I was thinking that the attorney came up when they gave him that shit. I'm thinking this thing, he got $20,000 worth of.
But $243,000.
Yeah, 2,000.
Yeah.
$2,000 worth.
See,
of stuff. But they're gonna be sold.
who do you think is the winning here? The business or the lawyer?
I think the lawyer is still winning because that builds up. You got 200 shares. Just cause like the way over time, but as far as right now, the company, the corporation Rexio is winning because that's $3,000 worth of legal fees that you just gave them for 200 shares at par value of $10.
Okay. Anyway, so let me just put a note here. Issue of stock for other than cash, for other assets. Now, one more example. Okay. Issuance of stock for non-cash assets when market value for the stock exists. Now we know what the market value of the shares, but we don't know the value of the asset. In the next example. So 2 years later, Rexio exchanged 500 shares of its $10 par value common stock for a piece of land. At the time of the exchange, Rexio stock was selling on the market for $16. But we don't know what's the value of the piece of land. So what are we going to debit here in this case? Now what are we getting? We're getting land.
So we'll debit the land.
Okay, so we're going to debit the land. We're going to hold on the amount for a second.
Put a question mark right there.
Okay, no, and then we're going to credit
Common stock.
common stock exactly for now 500 shares times 10 is $5,000. $5,000. All right, and we're going to credit
Additional PIC.
credit additional PIC. Now the land is going to be 500 times 16.
Oh, okay, so
Yeah.
that's 8,000.
How much?
8,000.
8,000? Okay.
So the additional PIC is gonna be 3,000.
So that's going to be 8,000. And the difference is $3,000. Okay? Easy, correct? Yeah, just remember, automatically you debit either the cash or the asset and you credit common stock. And then you're going to also, to make up the difference, additional PIC. PIC meaning?
Paid in capital.
Yes, sir. Additional, yeah. Additional paid in capital, yeah. Because we write the word additional, yeah. On the test, don't write PIC, write the whole word. I can say PIC, yeah. I know what it is, yeah. So for you to remember, you need to say Additional paid-in capital, yeah. All right. Now, let's talk about the treasury stock. Okay, I wish we have the recording from yesterday, but I didn't save it. Yeah, I didn't save it in here. But why would, like we said, why would the corporations want to reacquire, I mean purchase back their shares? For several reasons, like we mentioned yesterday, and there are 5 of them here, as you can see on that list. To distribute to employees through stock options, to maintain a favorable market for, and on and on. All right, so let's do an example on page 506. On September 15, Capo Corporation purchased 2,000 shares of its common stock on the market at a price of $50 per share. So let me just put a title, a different title here. All right, and go back to here and I say treasury stock. Treasury stock. All right, and let me bold it and all right. So when the company buy back its shares, automatically we debit. What do we debit? Treasury stock. Debit treasury, TREA, treasury stock. Now this is a common, all right? The common stock, they are buying it back. So you're going to put a comma or dash common, all right? For how much they purchased it? For $2,000. They purchased 2,000 for $50 a share, which come up to
100,000.
how much? 100,000. That's correct. So you got the dollar 100, 1, 2, 3, and we're going to credit. Guess what?
Cash. Right.
Yes, sir.
Yes.
Because we paid cash, correct?
Paying for it.
For how much?
$100,000.
100. Why don't we use BIC here? Like what we did with the others.
Because
Uh-huh.
you're not. I mean, you're not spending your own money, right? Like, I mean, you are spending your money. It's like you're not.
I think that's the reason.
Oh, okay.
No, I'm just saying that was my opinion. I think what you're saying is the reason.
Yeah.
Why? Yeah.
No, because this becomes, see, those shares you're buying back, you're going to treat them in a special way now. They are separate from the
Ones that you.
others, the outstanding. These are issued, but they are not outstanding now. They are issued, but not outstanding. We
have them.
we have them. The
outstanding
corporation
ones
has them.
are
Yeah.
in
So
circulation.
that $20 here, you see, $50, that becomes almost like a par value now. Almost like a par value. Subsequently, if you sell some of those, you got to see the difference between the $50 and what you're selling it for.
Okay.
So if you sell it for over 50, for 70, that means we have additional capital, but it belongs to treasury. Remember, you have to separate the additional capital, whether it's
These are
common
treasury stock.
or preferred or treasury. Yeah.
Okay, these are, so the ones that you took back, that's your treasury stock, and then when you sell it, it goes in a whole different category.
Yes, sir.
So that'd be like your treasury stock shares, basically.
Yes, sir.
Okay.
Yeah. If you sell them back, they become normal, regular stock. They become outstanding common stock. If you sell them back, yeah. All right. Okay, so let's say Look in the middle here. How would at this time? How would look like? How would stockholders' equity look like? At this point, it looks like contributed capital. We have a common stock, 300,000. PIC 360. Total contributed capital. Retained earnings. See, there is a subtotal of 2 millions and something.
$60,000.
Okay, yeah, no, subtotal after this one.
2,100,000.
Now minus
treasury.
it becomes 2,060,000. Yeah. All right. That's where it is located. Yeah. All right. On the sale now, on November 15, Kodak sold 2,000 shares of its $5 par value common stock on the market at a price of $50. All right. So now remember that was the par value.
Oh yeah.
Yeah, that was the par value. Now they are sold for $50. Yeah. So we're gonna once they are sold, we're gonna debit cash. Because we are getting cash paid. Yeah, okay. We debit cash for $100,000. Yes, sir. Right. And we're going to credit. What do we credit? Treasury shares. Credit. Since they are not making no money on this case because it cost them 50 when they bought it back, now they're selling it for 50. So there is no PIC. Yeah.
55.
Yeah, there is no PIC at this time. Yeah. All right. So treasury stock 50, 100,000. I'm sorry. 1, 2, 3. All right. There is no PI. So at this point, there is no treasury share now. They are all circulating in the public as of now. Now let's assume they sell this corporation sell the treasury for over $50. All right. So on next transaction on page 507, it says on November 15, Kodak sold 60. Oh, wait a minute. They originally purchased 2,000, correct? No. They originally, 2,000. But they sold all of them. Sorry, they sold all of them. Yeah. And that in the previous example. Now in this example, on November 15, Kodak sold for $60 per share 1,000 of those. Now this is independent situation. Yeah.
Oh, okay. I was like, well.
No, that's independent. Yeah.
No, we don't have no more treasury
Yeah.
stock left, but.
Yeah, it's an independent. So 1,000 at
Shit, that's a come.
the original cost was $50, correct?
Yes, sir.
And they sold it for 60. So therefore, what we're going to debit?
Cash.
Yes, sir. We're going to debit cash for how much?
60,000.
For 60. Wait a minute. 1,000 shares at $60. Yes, sir. You're right. Yeah, 60,000. And they're going to credit.
The treasury stock.
Credit. Treasury. Stock. 1,000 at 50.
50,000.
50,000.
And this time we do have payday.
And yes. And we're going to credit additional
PIC.
Additional
Treasury.
PIC, comma, treasury, yeah.
That's $10,000.
Treasury for $10,000. All right? Got it?
Yes, sir.
Okay. Now we have some issues now. Gonna Gonna happen in a minute, yeah. The issue is, before we, what happens if you sell those treasury sticks below $50?
Go lost.
Yes. So what are you going to make up with that loss? You're going to go back to the PIC treasury, this additional capital treasury.
Oh.
So you make up the loss from
The treasury.
PIC, yeah.
And you have to subtract from
Yes.
the PIC that you have.
That means we have to debit the PIC.
Okay. I feel
Because the original balance is, as you can see,
10,000.
credit. And when we reduce it, we
Debit.
debit it. What if we don't have enough from the PIC treasury? We're going to come up with a difference.
You gotta pay out of pocket for cash.
Not out of pocket.
Oh, well.
Out of the pocket is the business.
Oh, you gotta.
Which
sell some
account
shares.
is that?
Withdraw? No, I won't say no withdraw.
Which account that we have to dip into?
Assets?
No. What are the components of stockholders' equity?
Oh, I contributed capital, right?
What if we don't have enough in it?
Then we have to go to, we don't have any, additional PIC for the.
If is not enough in the additional PIC treasury?
Yeah, take out a loan or something. That.
No, contribute in the retained earnings.
Oh.
You forgot about retained earnings? That's,
I'm
yeah,
thinking
you
we
take
had
it out of retained earnings.
I'm thinking we had everything else. Bro.
Yeah.
We ain't got nothing retained earnings left either. Bro.
Yeah, you forgot. You take it out, so you have to debit retained earnings, yeah.
Okay.
So again, number one, if you have enough in the PIC treasury, you take all the loss from it. If there is no enough, let's say you have a portion, you still have a little bit of a treasury, PIC treasury, you take that portion, and the balance you take it out of
Yeah.
retained earnings. Yeah, okay. So if let's assume that the loss is 11,000.
Oh, okay. So
If it's 11,000, we only have 10 here.
so you're gonna take 1,000 from your retained earnings.
Retained earnings, yes, sir. All right. So with that in mind, let's look at the next transaction. Sale of treasury shares below cost. Below cost. When the treasury, okay, let's say on December 15, we're on page 508. On December 15, Kodak sells its remaining 1,000 shares for $38 per share. Now they are selling it for 38. Let's see if we have enough. So we're going to debit what? Still debit cash.
Cash. Oh, yeah.
We're selling it, remember? We debit cash
38,
for 1,000 times 38 is what?
3,800.
3,800?
38,000.
38,000? All right. 38. 1, 2, 3. And we're going to credit.
The treasury stock common.
Treasury. Not common. Yeah, treasury. Yeah, okay. That's fine. Treasury stock for
50,000.
for 1,000 times 50. You're right, 50,000.
So
Now
yeah.
we are short
12,000.
12,000. We're going to get it out of.
Additional PIC.
Yes, sir.
For treasury. We got
Credit.
No, we had a debit there.
Additional.
Don't we have to debit that?
Yes. No. Oh, yes, sir. Ooh, what am I doing here? You are absolutely right.
I wasn't paying attention now.
You are absolutely correct. Let me, now how can I put this down? Let me add the line here. No, I don't want to add the line. I'll just go ahead and do it over the cash, all right?
Okay.
Yeah. So we debit additional PIC treasury. For
10,000.
10,000.
10,000.
No, wait a minute. For 12,000. Oh, yes, sir, for 10,000. That's all what we have. You're right about that. See, you're following the rule and I'm not. 10,000. All right, and we have a difference of what?
2,000.
Where are we going to get this 2,000 from?
Retainer.
Yes, sir. Now you're getting the draft. So I'm going to put one more debit. Retained earnings for 2,000. All right, now it's balances, yeah. Okay? This is the accounting for a, when you sell it for below the cost, yeah. Okay. Now, what if we retire the shares, those shares, treasury stock? Retiring means it's no longer authorized, no longer issued, no longer outstanding, completely out.
So once you transfer what your funds have into, well, you're just gonna move that money into like your, yes.
Now let's just read this paragraph.
Oh, okay.
In the retirement of treasury stock. Let's just read this paragraph for a second. If a company decides not to reissue treasury stock, it can retire the stock. All items related to those shares are then removed from the associated capital accounts. If the cost of buying back the treasury stock is less than the company's received when it issued the stock, the difference is recorded in paid-in capital retirement of the stock. If the cost is more than was received when the stock was first issued, the difference is a reduction in stockholders' equity and is debited to retained earnings. All right? It's just the same idea that we had a minute ago. So let's look at this transaction for a second. On November 15, Kodak decides to retire 2,000 shares of stock that it bought back for $100,000. Now, anything belongs to those shares, you got to take it out of the records. If they have a PIC, you take that PIC out of the records, yeah. Okay? For those 2,000 shares. So, in this here, we're going to look at the par value. So we're going to, now remember, originally it was it's also no longer common stock. It was retired, if we retire. So we're going to debit common stock. We're going to debit any PIC if it's available. And we may have a gain or loss in this case. And we're going to credit cash for sure.
Okay.
Because well, no, sorry, not cash. We're going to create a treasury stock. Sorry, it's no longer. Yeah, we're going to trade. That means you zero it off. Yeah, its original balance is debit. When you credit it, that means you reducing it or you removing it. All right. So they decided to retire those 2,000. No longer. They're going to keep taking out of the records. All right. So we're going to debit common stock. Okay, retirement. Let me just say, write down here, retirement. Retire F2. Let me go back. Retire E, correct? Retirement of treasury stock, of TS treasury stock. All right. Retirement of treasury stock. All right, so we're going to debit common stock at par value. 2,000 shares times, what was the par value? $5. 2,000 times 5 is $10,000. All right. And we are going to get rid of PIC. Does it have a PIC?
Yeah, because they were issued at $6 per share, so yeah, they're going to have
additional PIC treasury. T for treasury. How much was it?
It's gonna be 2,000
How did you come up with the 2,000?
because the stocks were issued at $6 per share, so you're gonna times 2,000 by 6. It's gonna be 12,000.
Originally it was issued for 5, correct?
No,
The par value was 5, sorry.
But they
Issued it at 6.
Yeah.
So we have 2,000 times 1
Times 6.
time,
Times
2,000 times 1,
Time
$1
one,
difference.
Yeah, 'cause the 5 is
Between 5 and 6.
Oh, you doing the
Yeah.
difference. Okay, so wow, so it's 2,000.
So it would be 2,000.
Okay, I'm tripping.
Now the question is, what was the, how much did they originally pay for it? 50,000. Remember they purchased it for 100, sorry, you're right. 100,000.
You messing me up.
Yeah. Treasury. So we're gonna, let me just say credit, treasury, stock for 100,000. Now, they don't balance, correct? How much is the difference?
88,000.
88. There is no additional PIC treasury, therefore
Retained earnings.
retain earnings. Yes, sir. So we're going to debit
Retained earnings for 88,000.
retained earnings for 88 plus you 1,000. All right, this is the retirement of the treasury. TS is treasury stock. All right, now do we have anything else left? Yes, we do have a couple of things. Now the dividends. We need to look at the accounting for dividends. We'll just do the cash dividends for now. We'll just do that, and the stock dividends. We still have 3 items left, and then we'll be through with this chapter. 4 items, yeah. So, like we said last time on the dividends, there are 3 dates. Whether it's cash dividends or stock dividends, there are 3 dates. You remember those dates?
The declaration date.
Declaration date,
Record date.
date of records,
Payment.
payment date. Yeah, so remember those 3 days associated with the issuance of cash dividends or stock dividends, both. So let's look on page 511. All right, page 511. On the bottom of the page, assume this dividend transaction. You see that? Assume a board of directors declares a cash dividend of $28,000 on December 21st. The record date is December 31st, which is also the end of the company's accounting period. The dividend payment date is January 11th. So the declaration date is December 21st. The date of record is December 31st, and the payment date is January 11th. All right? On the declaration date, we do a journal entry. On the date of records, we don't do journal entry. On the payment date, we do a journal entry. Yeah. So let's do those journal entries. On the
This like from Prince County 1, like the first chapter when
Yes, you're right. You still remember that.
Yes, sir.
Okay. So on the declaration date, we're going to say dividends declared. We're going to debit dividends declared and credit dividends payable. All right. You could say cash dividend declared and cash, because I think it's important that we put also the word cash. All right. So we're going to debit because we got to say whether it is cash dividend or stock dividends. So we're going to debit cash dividends declared all right, declared LA, correct?
Cash dividends declared.
LARED, correct?
LARED.
For how much?
28,000.
All right, 28 dollars. 28, 1, 2, 3. All right, and then we're going to credit cash dividends payable. Credit cash dividends payable for $28,000. All right. This is the declaration of dividend. Once it's declared, the corporation must pay it. Yeah. Okay. If it originally it's not a liability. If it's not declared, there's no liability. All right. If it's not declared, but once it's declared, it becomes. See, we credited dividends payable. That's a liability now. It has to be paid to the shareholders. Okay. On the record date is what? Which date is the record date? December 20. No.
31st.
December 31st. On December 31st, no journal entry. All right. No journal entry. Is only a memorandum. Okay. And so on the payment date, that means it has to be paid. There's cash involved. Okay, on the payment date, we're going to debit what? Remember, we have a liability?
Dividends payable.
Yes, sir. Cash, dividends, cash dividend payable. And we're going to credit for how much? For 28,000. And we're going to credit cash for $28,000. All right. So these are, let me write down accounting for dividends. Cash dividends. So let me just do bold and all right. Okay, so we hopefully a couple of things stock splits. Sorry, stock dividends, stock split, and the book value per share. Those are the three items left. And by the grace of God, tomorrow we will finish those, and we will practice. I think by then I may be able to ask the registrar's office to really assign it, and I'll start putting assignments online for you.
Yes, sir.
Okay? But we got to have the file.
Yes, sir.
Okay.
So,
I'm about to do it right now.
so what will happen if we don't get the file?
They won't have it.
Then they're gonna drop this quiz?
I don't know if they drop it. We'll just be aware that
Technically,
there's a possibility.
right now,
Yeah. It's a possibility. Just be aware of that. Okay. Hopefully not. Let's hope not. Yeah. Hopefully not.
Yeah,
ain't no telling after what they
I'm
did.
trying another 6 months to take this class. I already got my book for both.
Yeah. Hopefully not. Hopefully it will stay with 4. Hopefully. Yeah.
Oh, yeah.
Yeah. Okay. Mm-hmm.
Nah, but we should get more. I just told Jerry we need to
I just told him, I called Tyler and told him to call me back.
That brother was supposed to. I told him he wasn't gonna make it because he came from Mississippi.
Uh-huh.
He got back for this morning. I know I got back from Houston at 3 in the morning.
This morning?
No, Monday.
Ah,
I
okay.
got back at 3.